Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Central New Energy Holding Group Limited annual report. Central New Energy Holding Group Limited is a diversified investment holding company with various business segments. The company's primary focus areas include construction works, green building, smart energy management services, health and wellness, and food and beverage supply chain. The company operates through several key segments: New Energy and EPC, which involves the manufacturing and sales of photovoltaic products; green building and construction-related business, which includes piling works, excavation, property development, and property management services; smart energy management services, which provides energy-saving solutions and information technology development services; health and wellness, which offers healthcare consulting and healthy food; and F&B supply chain, which involves agriculture products and food materials supply. In essence, Central New Energy Holding Group Limited is a conglomerate with a wide range of business interests across various sectors. Central New Energy Holding Group Limited maintains a market capitalization of $34 billion, broadly in line with the industry peer group. Central New Energy Holding Group Limited trades at a higher price-to-earnings ratio of 403 times and a higher price-to-book ratio of 26.17 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 66% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Revenue growth in the company is primarily driven by 3 key segments. Firstly, the New Energy and EPC segment has been a significant contributor, with notable increases in sales volume of PV components and high-efficiency N-type batteries. This segment's revenue has grown substantially, reaching $530,316 on page 8, and further increasing to $15 on page 18. Another key driver of revenue growth is the Health and Wellness segment, which has seen strong growth in sales volume of green food products. The company's revenue from this segment has increased significantly, with a notable jump of $772,774 on page 8. Additionally, the Smart Energy Management Services segment has also contributed to revenue growth, with increases in revenue reaching $111,638 on page 2 and $602,118 on page 9. On the other hand, there are 2 segments that have experienced a decline in revenue. The Green Building and Construction-related business segment has seen a decrease from 5.5% to 15.1%, indicating a significant drop in revenue. Similarly, the F&B supply chain segment has also experienced a decline, with its revenue decreasing from nil to 0.1%. These declines are notable and may require attention from management to address any underlying issues. The company's financial performance suggests a positive trend. According to the extracted summary on page 4, the net cash inflow for 2025 was $50,789, indicating that the company is indeed generating positive operating cash flow. This is a significant indicator of the company's ability to manage its finances effectively and generate sufficient revenue to cover its expenses. The company's debt level and interest expenses have undergone significant changes. On the one hand, lease liabilities have skyrocketed, with a staggering increase of 42.16% in non-current liabilities and a whopping 15,555% rise in current liabilities. This indicates a substantial shift towards leasing arrangements. On the other hand, borrowings have decreased by 27% in non-current liabilities, but increased by 2% in current liabilities. Despite this mixed trend, the overall debt level has likely increased due to the significant jump in lease liabilities. The interest expenses have also seen a notable rise, increasing from $385 million to $66,564 million. This represents an increase of approximately 30%. The substantial growth in lease liabilities and interest expenses suggests that the company is shouldering more debt-related costs. The company's performance across various segments has been mixed. On the positive side, New Energy and EPC have seen a significant revenue increase of 106% from $4.13 billion to $0.53 billion on page 8. Green Building and Construction-related business also performed well on page 9 with a revenue of $8,530,316. Additionally, Green Building and Health and Wellness segments showed strong performance on page 10. However, some segments have underperformed. On page 8, the Green Building and Construction-related business saw a decline in revenue by 33% from $908 million to $602 million. The Smart Energy, New Energy, and EPC segment also experienced a downturn on page 10. Furthermore, Health and Wellness has seen an increase in liabilities on page 11, indicating financial struggles within this segment. Management's outlook for the company is centered around a significant shift towards renewable energy initiatives. They have identified this area as a core growth driver, indicating a strong commitment to investing in sustainable technologies. This strategic focus will not only contribute to reducing the company's environmental footprint, but also position it at the forefront of the clean energy sector. The company's vision for the future is ambitious and forward-thinking, aiming to become a leading architect of a decentralized, resilient, and clean energy system. To achieve this goal, management plans to leverage their existing expertise in new energy projects to explore opportunities along the Belt and Road Initiative. This strategic move will enable the company to tap into emerging markets and capitalize on the growing demand for renewable energy solutions. Overall, management's strategy is focused on driving growth through sustainable means while positioning the company as a leader in the clean energy sector. The company's financial performance and shareholder returns are reflected in its dividend payments. According to the provided summary, it can be confirmed that the company has indeed paid dividends, as mentioned in Note 7 on page 3 of the extracted summaries. However, there is no information available regarding share buybacks. This suggests that the company has not engaged in any significant share repurchase activities, at least based on the data provided. That concludes the financial summary for Central New Energy Holding Group Limited. Feel free to comment below, and I will be happy to answer them when possible.